tuning in to another episode of Retire Right. I am Ryan Wyatt, and I am joined today by Ron Wyatt and Nick Lewandowski. The three of us are wealth advisors here at the firm. Ron and Nick are both on the investment committee. In the last episode, we made the formal announcement that Nick is co-chair on the investment committee.
Still waiting for my bonus.
This is round two of congratulations, Nick. What we're going to talk about today is private investments. Talk about how they're different than traditional investments or asset classes, stocks, bonds. Why a retiree should consider them in their portfolio. Of course, we'll get into some of the risks. Benefits with private investments. We will then start to transition into how it fits into our philosophy and whether certain firms actually have access to these types of investments, more access, I should say, over others. Those are all the things that we're going to cover today. So with that said, Nick, if you could just start with giving an overview on what private investments are.
Mm-hmm. So we're thinking about private versus public investments here. The distinction is just, does it trade on an exchange? So traditional stocks and bonds, we're used to being able to buy and sell, pretty much any time during market open hours. With private investments, we are not able to do that. The other aspect of this is sometimes there's confusion about the distinction between traditional stocks and bonds, so public investments, I'll say, private investments, which just talked about a little bit, and alternative investments. And the way I would encourage people to think about this is think of stocks and bonds as your traditional public investments. Alternative investments, broadly speaking, you can think of as like things that are different from that. And private investments sometimes are considered a subset of alternative investments because they don't trade publicly. But most times, a lot of times when people think of alternative investments, they're also thinking about things like gold, crypto, commodities, weird stuff, like I'll say outside of the normal thing. We're not going to talk about that stuff today. We're going to talk about private investments specifically. So we're talking essentially about stock-like investments and bond-like investments that don't trade on public exchanges when we talk about private investments. There's some differences. The key difference is, I've really already said it 3 or 4 times, not publicly traded, and we're going to come back to this over and over again, because this idea that you can't just log online and sell it or buy it right away is really important to how these things work and the benefits and risks associated with them.
Perfect. Thank you. That was well said. Ron, can you explain why a retiree should consider private investments in their portfolio?
Yeah, so the first reason is not in any particular order, but the opportunity set. Now, what I mean by that is if you look at the peak in 1996, there were a little bit of over 8,000 companies listed in the United States. Today, it's around 4,000. So 4,000 is still a lot of companies, but the opportunity set has gone down a lot. Some of it through bankruptcy, some of it through acquisitions, mergers. Now, on the other hand, if you look at private equity companies that are private companies that are backed by private equity firms, there's about 11,000 in the U.S. and globally there's over 200,000. So it really expands your opportunity set. That's the first. The second is return. Especially with private equity, the returns have been better than public equity, and it's naturally, it's very natural to wonder why. And part of that has to do with a lot of times the private companies are less expensive. Vanguard just did a report showing you the valuations of public versus private. Private's cheaper. So when you buy a cheaper company, all else being equal, you should get a better return than buying an expensive company. On top of that, sometimes the private equity firms will use leverage, which can, most of the times help returns can also help. It can also make it riskier. And public companies are reporting every quarter, and the private companies can think longer term, which gives them advantage. So those are a couple of the reasons.
Okay. So far it sounds like, just saying, hey, it gives you access to more opportunities by itself. I don't think that there's a lot of like meat there, but it's giving you access to a very large, using your words, opportunity set that the returns have been better, the valuations
Absolutely.
are lower, et cetera.
Right. The risk, it doesn't seem to be as risky as public, but like Nick said, there's less volatility. Again, we'll get into that later. And there's some diversification benefit to adding private investments to your portfolio. And a lot of it has to deal with that because private investments are not priced daily, they might be priced monthly or quarterly, they tend to be less volatile. And there's a lot of debate as to why that is, but it's kind of, think of it this way, like your home. Your home doesn't fluctuate a lot day by day, right? But if you look at publicly traded real estate REITs, there's a lot of change because the market information, the news is readily available, and short-term sentiment, can sometimes be really negative or really positive, where it doesn't affect private companies as much.
Okay, gotcha. So those are the benefits. Nick, do you want to talk about some of the risks and the downsides of the private investments?
We try to be transparent at all times as best as we can. It's really important to us, and acknowledge that there's no free lunch with any investment. So if you're getting benefits, there's got to be something that is the cause for that, or the con side of it. And we'll talk about that in a second. First, I just want to address that there's often a perception amongst some people in our field that private investments are like inherently dangerous or like inherently bad because they are more complicated and because there are some downsides. I encourage people to think about this like, if you needed to break up a rock for a project, you can use a hammer to do that. You can use dynamite to do that.
Yeah.
Dynamite is they both have different implications, right? The dynamite sure might be a lot more dangerous, but sometimes it makes sense to use it. You know? And
I'm really curious where you're going with this. But continue, please.
My point is, if you don't know what you're doing with something and you don't understand how it works, you can blow yourself up. That's why I chose that specifically. Yeah.
I got it.
But it doesn't mean that if you need to break up a rock to build a tunnel that you should only use a hammer, because it'll take you a million years and maybe there's a better tool. So that's the frame I would encourage people.
By the way, just for the record, if I were to break a rock, I think I would do some sort of like roundhouse kick type movement. But
I don't work out like you work out.
I'm just picturing it.
Yeah, right.
But anyways,
so examples and joking aside, like the point is that when you bring additional complexity in with these strategies, it's all about understanding the benefits and drawbacks and make sure you're using them appropriately to get what you need out of them. So the key risks that we want to highlight for people, I mean, we've talked about it a bunch of times, but I want to underline it here because it's the number one thing, is this concept of illiquidity. When you put money into a non-publicly traded investment, that money can be tied up for years. I don't mean 3 years, I mean 5, 6, 7, 10 plus years in some cases. Depends on what you're in. This is really, really important for people who are entering retirement and thinking about, like, do you want your money potentially locked up if you want or need access to those funds? It's the most important thing in my mind.
Okay.
Fees, we have more complexity, so the cost does tend to be higher. Sometimes the fee structures can be a little more complicated depending on the type of private investment as it is. Makes it a little tougher to understand. General complexity in the investments. You probably gathered from some of the details that Ron provided on the benefits that there's some additional things in play in terms of, what companies are owned. They don't report like the same way that public companies report. Is the private equity firm using leverage, in the companies, all these things. And then there's the valuation piece, which means when you want to look at the price of Amazon or Microsoft shares, what do? You log on, you look it up, and there's a quoted market price. That is not the case in the private investment world. The portfolios are valued essentially with appraisals, like your house would be. And so those prices may or may not be reflective at any point in time of what you could actually sell out of that portfolio for.
Yeah, by the way, just add to that, when there's a lot of transactions in, like, say you have similar private securities, they can use recent transactions also for valuation, right? It's when it's less liquid that the appraisal, becomes more important.
Okay. So let me kick it over to Ron. What are your thoughts around why private investments are suitable for someone, in or nearing retirement?
I think they're suitable for a majority of people, but not all people.
Okay.
So first of all, you always want to start with a plan, right? So your financial plan to achieve your goals. And then with the plan, you can find out, hey, what's the return I need? What's the risk I'm willing to take? What's my liquidity needs, right? So you can, you have to start with that. Okay, so let's just say that, private investments fit in. So some things to consider is, some people have difficulty with not being able to sell daily, but we keep the amount in private investments in all of our portfolios under 20%. Now, there could be some exceptions for very high net worth people, but in general, it's under 20%. So for almost all people, having 80% of a portfolio totally liquid should suffice. Okay, so first of all, it's that how much exposure do you want, knowing it's less liquid. Then on top of that, it's the willingness to be different. There's something called tracking error. Okay, so if you have the S&P doing very well or very poorly, how close do the private investments track the S&P? And there's some, like if you look at private equity and how closely it tracks the S&P, it will track it to a certain extent, but it will be quite different. And I think a lot of times the difference could be a positive, but sometimes it could be a negative. So again, just willingness to be different. And then also, you do have to factor in age. The ones we use, and we'll get into this a little bit later, are decently liquid. But if someone's 90 years old, you probably don't want to load people up with a bunch of private investments, because upon their passing, it may take a little bit of time for the beneficiaries, for the heirs of the estate to sell. And so we tend to be very cautious when people are getting older about the use or a high level of use of private investments.
Okay, so let me summarize where we're at so far. So private investments on the plus side, there's a larger opportunity set. Less companies have been going public over the years. It opens up another area in the market. That area in the market has had solid returns. There are some risk attributes that are lower, and there's also some diversification benefits for incorporating it into the portfolio. On the downside, there is that illiquidity premium. Okay, so there's no free lunch, like Nick said. So for some of those benefits to exist, there has to be the trade-off, and one of the trade-off is there's that money can be tied up for, depending on the investment, long periods of time, or even maybe 1 quarter out of the year.
Right.
The fees are a little bit higher. It's a more complex investment, and it's not as easy to value it. What Ron's saying is why it fits into the portfolio, or how it fits into the portfolio, is by starting off by essentially mapping out someone's entire financial situation into a retirement plan, so that you can figure out very detailed information, like what are their needs for liquidity year over year. And then once you've addressed all of those individual components, then you can make the case for whether private investments should be included into the portfolio or not. Is that a fair summary on where we're at?
Excellent summary. I just want to add something to that. You mentioned the word illiquidity premium. Very proud of you, by the way. And what that is,
does that mean I'm promoted to co-chair?
Yeah, I'm thinking about it. It's going to get confusing.
Co-chair.
I think I'm going to get kicked off the investment committee soon. But think of the illiquidity premium as this: if you give up something, so you give up some liquidity, you have to get something in return.
Right.
If you don't, why would you invest
why
in
would you do it?
It makes no sense, right?
And then you could make the same argument for the fees. Like, obviously, we're always looking at fees. You want to lower the costs on investments as much as possible
Right.
while maintaining quality, because the higher cost investments you have, the lower the net returns will be. So if you're going to pay more in fees, there has to be something
for
there
it,
on
right.
the other side of it as
We'll
well.
get into that, right? Exactly.
All right. So Nick, how do we access? Like, how does somebody access these private investments?
Yes, and I'm going to draw here on my due diligence experience from my prior role. I did a lot of research and due diligence on private market strategies and funds and things there. So the first thing about access that's important is not everyone can get into every private investment fund that's out there. Some are pretty flexible. There are investment minimums usually that are much higher because essentially what the folks who run these funds want to do is they want to make sure that it's typically higher net worth clients that are in them because they have more ability to bear the illiquidity and the investment risk. But some funds have even higher thresholds applied beyond the minimums. Like you'll hear things like accredited investor is the most common term, which means you have $1 million of investable net worth outside your primary home. There's an income requirement
I think it's 250
as well.
or something like that.
It's like
yeah.
200,000 for an individual, 300,000 for a joint couple. But then even beyond that, there's like the qualified client threshold, and
Yeah.
qualified purchaser threshold. They're just different thresholds of net worth.
There's barriers to entry, and they're there for a reason.
So you need to understand what you can access based on the resources of your situation is the first thing. The other thing that's really important, as you can probably gather from this conversation, it can get really complicated, right? So having someone like a qualified financial advisor to navigate the space helps you deal with the complex terminology and the jargon, which has probably come through in this conversation, translate all that, help you understand it. It's kind of like if you're going to go on like an expedition to an uncharted area of the world. Like
Here he goes again.
Yeah.
Where's he going?
I love his
Where's he
stories.
going with
I'm
this?
doing the metaphors, right?
Are we going to the Amazon or something?
Like you're leaving the safe world of the public markets and you're going into the wilds of the jungle, right? You could do that all by yourself, but you might want to pay a guide.
Okay.
At the
Okay.
end of the day,
Yeah.
to help you navigate and those sorts of things.
I like that metaphor. I think
Yeah.
that was good.
So, all right. so then we get back, and I'm going to go through these quickly, but the things that your guide or you should be thinking about is you want to understand, at least at a high level, the investment strategy. What are they buying? How do they hope to monetize it? Are they going to sell the assets? Do the assets produce income? How are you going to get your money back?
Sure, okay.
Ultimately, is the key question. You want to understand how diversified the fund is. A private fund that owns one private company in it, which do exist, is a lot more risky than, Ron will talk about what we use in a bit, which is much more diversified. Some funds have not many eggs in the basket, so to speak. You need to understand the fee structure. Some alternatives, especially as new products have come on the marketplace, have very simple fee structures. Some are very complex and very expensive. You need to know how the fund company is getting paid and how much you're paying. Got to understand when you're allowed to take your money, if you're allowed to take your money from the fund, that will differ. And then you got to understand your tax reporting. Some private funds report on a 1099, like most people in the audience are probably used to. Many that are structured as limited partnerships use a K1. Most people who get K1s hate them.
Yeah.
So, it's something to be mindful of. And from my due diligence days, I can't help but underline, you got to read the documents. Do not assume that this stuff just works like the ETFs that you're used to, the mutual funds that you're used to, buying and selling stocks on a public exchange. You got to read the fine print to know what you're getting into.
Okay.
So the other piece that's relevant is you're generally going to encounter two structures in this space, and I'm going to cover them real quickly. Interval funds, which is what we use, and Ron will talk about that a little bit more. An interval fund is much more like a mutual fund for private investment. They usually do offer some liquidity, meaning like quarterly or semi-annually, they will allow a certain amount of money to come out of the fund, so you're not totally locked up. But they may say, like if the market's bad, they may say we're not doing any redemptions.
Yeah, during market stress, if a lot of people are running for the exits and you request money, you may not get all of it. You may get a portion of it.
The other very common structure is a limited partnership structure, and these come in many, many different shapes, forms, and flavors. You may not be able to take your money at all out of a limited partnership private fund. You may be stuck in there for 10 or 15 years, depending on the nature of the fund.
What are the longest ones you've seen?
The ones that work badly, if it goes bad and you're in a fund that doesn't offer liquidity, 10 or 15 years,
And by the way, that's why we stay away from this.
Yeah.
Okay, I just wanted to emphasize that.
So we don't use that. Those will also report on the dreaded K1 that I referenced, a little more complicated tax reporting. And just in general, the fund terms and the fees are going to be non-standardized in the limited partnership world. So you got to read the documents and you got to make sure you understand what's going on there.
Is there anything worth mentioning about how our firm is structured as a registered investment advisory firm and having unique access to different private investments versus some of the large, broker dealers like maybe a Schwab or Fidelity or Vanguard and their access on the retail side to private investments?
Like a Merrill Lynch or
There's a couple things worth saying. So if you're not working with an advisor at all and you're just on a retail brokerage platform, you likely have limited access to alternative products because most of the firms who are in this space don't want the compliance risk of people who don't understand that what they're getting into coming into their funds and then having a bad experience and suing them.
Yeah.
So a lot of times the access is limited on retail platforms altogether. On other brokerage platforms, there's a bunch out there. I'm not going to name names, because that's not what we do, but they will often have a curated selection of them. It could be a fantastic list. It could be maybe not a fantastic list. And the reason for that is sometimes there's some pay-to-play stuff that goes on those platforms between the fund sponsors and the folks who are making the list, which compromises the objectivity that's happening.
Yeah.
For us, we're in a great place. Independent RIA, we are not paid by any of the vendors ever whose products we use. So if we recommend a particular interval fund, because that's what we use, it's because we believe it makes sense for our clients. We believe the terms are appropriate and the cost is appropriate, not because we're getting a little side share of whatever's going on here.
Okay.
And also, a lot of the ones we're using are not available on large broker-dealer platforms.
Any reason why?
There's a preference to working with registered investment advisors. Nick, anything to add to that?
Yeah, I think the preference for working for registered investment advisors
Fiduciaries, right?
Fiduciaries. And the firms who are good sponsors don't want investors who don't understand what's happening or that the product isn't appropriate for, the strategy is not appropriate for getting in there. They want to work with RIAs because the RIA understands the client and is explaining and educating the client. And so everyone's kind of in it for the right reason.
It sounds like it's almost a way for them to control the inflows that they have into the investment and make sure that it's a higher quality investment, because they know at registered investment advisory firms where the advisors are fiduciaries, they are functioning through that lens of, is this the best thing for the client?
Well said.
Right. The gist of it is we have access to, it might surprise a lot of people, but we have access to an investment system and the larger firms don't.
Yeah.
And it might go the other way too.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
Ron, how do private investments fit into our philosophy?
So we have a framework called All Season, and all that framework is about is trying to give a good return that's less volatile, that's more consistent, right? And there's different types of environments. You could have the economy being strong or weak, inflation high or low. And so probably best is to give you specific examples. So there's something called private debt. It's debt of companies that is not publicly traded, and it tends to be floating rate. And what that means is when inflation's going up, interest rates go up, and most bonds go down in value. But a floating rate bond will actually increase what it pays you So the price tends not to be sensitive to interest rate movements. Okay.
Okay.
So recently, when rates went up a lot from 2000 to recently, bond prices got hit really, really hard, the worst bear market ever in bonds. But floating rate private debt did pretty darn well. Basically, did about as well as stocks did.
So there's less impact on the price, and then what you see is that when interest rates rise with inflation, the underlying rate on the investment is actually increasing as well.
Exactly.
So the yield is picking up for
Right.
people.
Like right now, the yield's probably around 10% net of the internal fees of the fund, which is very attractive. So people may wonder. I have people ask me all the time, and they look at the return of the one we're using or the ones we're using, why don't we just put more money in? Well, the reason being is that liquidity, right?
Right.
So what we do, going back to this framework, is most of our bonds are in treasuries, short, intermediate, long. That gives you liquidity. You don't have credit risk there. And the cliff water is there to provide that extra income and to help decrease the volatility according to interest rate moves. So it's a good combination. As Nick always calls it, a barbell combination, right?
Yep.
So that's how we use the private debt. Private equity, if you look at expected returns, we have access to a lot of different companies that can give you expected returns, and it's largely based on valuations and expected earnings growth for stocks. And most companies will show you that the expected returns of private equity is greater than public equity right now, and historically it's been that way too. So the one reason you may want to consider it in your strategy is the expected returns could be greater. We went over a little bit of reason why that is. And also, historically, they've been less volatile, so that helps the portfolio on both sides. Now remember, because you're less volatile here, but on the other hand, you're less liquid. So there's a major trade-off there that
Right.
you have to understand that.
Right.
And so that's why, kind of like why and how we're using the interval funds.
Is there anything else that you would want to add with, how it fits into our philosophy?
Not so much in the philosophy, but maybe Nick kind of alluded to this before, that we work more with interval funds than partnerships. I mean, really just exclusively with interval funds. And what we're doing is on the interval fund side is the one company we use a lot is Cliffwater. I'm not trying to advertise Cliffwater. I'm just using them as an example. But I almost equate them to like the vanguard of interval funds. And what they're trying to do is just give you very, very broad diversification. Their debt fund has over 3,000 different issues in it, 3,000 different companies, which is rather incredible, extremely diversified. Their expenses compared to the universe are very, very reasonable. And so, that's what we're looking for in a fund is diversification, reasonable cost, a good team that can select these investments.
Yeah, and the reason that we wanted to do this cover this topic on one of our episodes is there's a lot of debate in the wealth management space among advisors. Do you include private investments? Do you exclude them from portfolios for retirees? Is it making things too complicated? Do you just stick with the traditional investments? And our belief is simply, what we said earlier. You gather the information, as Ron always says, you get the data, and then you formulate your decision based off the data. And the data has led us to believe that this is a value add in our clients' portfolio, and I think a lot of them would resonate with that. They feel it, they see it. And so, we don't really put ourselves in that camp of thinking that it's overly complicated or that it's not a value add and you should stick with traditional. When it makes sense, the liquidity needs are met through the retirement plan. This is a really good way to help with some risk and improve some returns. So we hope.
Yeah, I wanted to
something.
add something too as you were talking. It made me think One of the other things, and this may be shameless self-promotion of us, but one of the things I think keeps some other firms, they just want to say, well, no, it's too complicated. It's bad. We don't want to touch it. Part of the reason they say that is they don't have the research or the investment experience horsepower, perhaps, to take a deep dive and really parse through it. And so the safest thing is not to touch it, because it's like,
right.
We've talked about, well, now that you're a co-chair, we have a triumvirate investment committee, and through the experience that all of us have, we're comfortable, digging deep and going
right.
into the weeds to understand what makes sense.
We also get a quarterly report that's excellent, that's basically covering all these less liquid investments. Some of them are partnerships, some of them are interval funds in different categories, debt, equity, real estate. And so it lets us look at returns, risk, fees, and then we can do a deep dive from there. So what I wanted to add, though, is my whole career, I've had, our accounts, my wife's account, my account, 100% in stocks, like our IRAs, 100%, never deviated from it. Just earlier this year, I took her account and my account, 20%, and put it into private investments. That was private equity and two different private debt funds we use. And so I did that not so much for the risk aspect. I did it for diversification. I did it for expected returns. I think that expected returns on the private side, both equity and debt, are similar, if not probably, I think they're actually better than public. So I put my money where my mouth is. I'm a strong believer, or I wouldn't have done it.
Yeah, I think that's a good point to conclude on. We hope that you found this informative. I mentioned this before, but for our clients listening, of course, questions, if you have any of them, reach out to us. Happy to further explain anything that we went over. And per usual, this podcast is really, it's meant to give you a deeper look into all of the things that we're doing internally that maybe aren't covered in length when we get together for our progress meetings. So if you have additional topics that you want us to cover, we are happy to do that. People have been writing in. We've had some great topics, some great episodes based on those requests. So please keep them coming. And per usual, we hope you enjoyed, and thanks for tuning in.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.